Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. Think about this. A company can post record profits but still destroy economic value. It's not as counterintuitive as it sounds. It happens all of the time. And it happens because profit, as accounting defines it, does not account for the cost of capital or the required investments. It can tell us what was earned and how wide the margins were, but not whether those earnings created or eroded economic value. And that difference between making profit and creating value is exactly what we're going to explore in this episode. Last two episodes, we laid the groundwork. First, we talked about the universal levers that drive value, revenue growth, operating margins, investment requirements. Then we looked at the different ways companies allocate their capital, simply where the cash goes and why those choices matter for value creation. Now, I want to build on that foundation and ask one simple question. What does it actually mean for a company to create value? Let's start with strategy. Strategists define value as the difference between what customers are willing to pay for a product and the cost of delivering it. If customers are willing to pay 10 Saudi riyals and the company can deliver it for 5, that's 5 riyals of surplus. And the wider that gap, the stronger the competitive advantage. And companies can widen the gap by charging a premium price or delivering at a lower cost, or sometimes a mix of both. And we explore this further in depth in episode number 8. Now, this customer value doesn't automatically convert into economic value. It's, let's say, potential value. Just because a company created a great product that customers love doesn't automatically mean that the company has created economic value. And here's the financial angle. You create economic value when the profit captured from customers translates into financial returns that exceed a minimum required rate of return. Simply the opportunity cost of capital. Investors always have alternatives, right? If they can put their money into a government sukuk and earn 5% with almost no risk, then a company earning 5% return on invested capital hasn't really created any value. Zero. The opportunity cost is the same. The key question is this. Can the business earn a return on its capital that exceeds the cost of that capital adjusted for the risk it's taking? And that's why intrinsic investors like to analyze companies from the standpoint of returns on invested capital. If those returns sustainably exceed the cost of capital, the company is creating value. But if they don't, the company is eroding value, even if the profit numbers look impressive. Let's look at two examples. Recall Talabat and SABIC from the last two episodes. Talabat is a regional on-demand delivery platform, and SABIC is a global chemicals giant. Two very different businesses, but perfect illustrations of my point. In 2024, Talabat generated a return on invested capital of around 50% on my calculations. And I'll use the cost of capital figure that Talabat itself applies for goodwill impairment testing, and that rate was 12%. So let's assume that that is the minimum required rate of return for Talabat. The spread between 50 and 12 tells you immediately that Talabat did not just make profits in 2024, it created economic value. In plain terms, they earned way above the minimum required rate of return. Not only that, but Talabat reinvested roughly 25% of its after-tax operating profit back into the business, on my calculations, because the company understood that each new dollar reinvested in the business was compounding at a rate above the minimum required rate of return. And that combination of high returns and disciplined investment was why they created value in 2024. Now, contrast that with SABIC. SABIC reported impressive profits in 2024, in the billions. But when you measure returns against the cost of capital, the story changes. In 2024, SABIC's return on invested capital was between 3 and 4%. Let's say 3.5% on my calculations. SABIC uses a cost of capital of nearly 9% for goodwill impairment testing. So let's assume that that is the minimum required rate of return. So the negative spread between 3.5% and 9% means that every new dollar invested in 2024 did not create value, even though the income statement looked quite strong. With a cyclical business like SABIC, though, 1 year in isolation can be misleading, and that is because investors in cyclical businesses may prefer to look at normalized mid-cycle levels. So, despite seeing some value erosion in 2024, it doesn't necessarily mean that SABIC will always be in that position. Now, these two cases underline a fundamental truth, and that is, profits show you if a company is selling products for more than they cost to make, and that is the accounting value that the company was able to capture from customers. But value creation asks a different question. Does this company generate returns above what investors could earn elsewhere? And it is that second measure that ultimately decides whether growth compounds into value or erodes it. By the way, the level of value creation or erosion in and by itself doesn't necessarily indicate whether a company's share price will rise or drop, because as we'll discuss in episode 6, share prices and valuations tend to move mostly on changes in expectations about future performance. If investors suddenly believe Talabat's future value creation will be less than they thought, its share price may underperform. And on the other hand, if the expectations about SABIC's value creation improve compared to what investors previously had in mind, its share price may rally. These are hypothetical scenarios, of course, just for the sake of argument. And by the way, the percentage spread between the return on invested capital and the cost of capital does matter, but what determines value creation in absolute terms is what's called the economic profit. And that is simply the spread multiplied by the amount of capital invested in the business. A smaller spread on a larger invested capital base can create more absolute value than a bigger spread on a smaller base. And that's why investors look at both the quality of returns in percentage terms and the quantity of value created in absolute terms. Now, this isn't textbook finance. Value creation principles are not theory. This is based on how intrinsic investors actually react to company signals in practice. To be fair, companies do put real effort into presenting revenue growth and profit margins in their investor materials, which is quite useful because it shows discipline in telling the growth story clearly. But the story becomes even more powerful when it also shows the investment discipline and return on capital, because profit margins alone don't tell the story. For intrinsic investors, these elements are central to understanding if growth truly translates into value. Highlighting them completes the growth story, which of course builds greater confidence and trust with investors. So, what's implied here? Profits matter, yes, but they don't tell you if investment is disciplined or if the company generated economic value. Intrinsic investors do not stop at the headlines and press releases. They follow the economics because numbers don't lie, as the saying goes. And they know quite well that making profit and creating value are not the same thing. And for companies, the real challenge, but also the real opportunity is to make sure that what looks good in a press release actually compounds into value over time. In the next episode, we'll shift gears to the quality of profits because profits often hide more than they reveal. I am Zein and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.